This week marks a historic turning point in global finance. The US dollar has fallen to a 4-month low, while gold has surged past $5,000 per ounce for the first time ever. Even more significant, gold has officially overtaken US Treasuries as the world's largest foreign reserve asset in 2026. For the first time in 3 decades, central banks now hold more value in gold than in American government bonds. With gold reserves approaching $4 trillion, surpassing the roughly $3.9 trillion held in U.S. Treasuries. This isn't just a shift in numbers. This is a fundamental transformation in how nations manage risk, wealth, and stability in an increasingly volatile world. Before we continue, let me be clear. Unlike channels sponsored by gold brokers who use fear to drive sales, Newsex's Brief doesn't sell gold or any products. My sole objective is to provide you with factual, objective analysis. I don't believe individuals should rush to buy gold simply because central banks are. Gold doesn't generate income, and its price can both rise and fall. Putting all your eggs in one basket is always risky, regardless of the asset. With that said, let's examine what's really happening. The unprecedented surge. The journey to this point has been extraordinary. In late December 2025, gold briefly hit $4,500 per ounce, a stunning 70% surge for the year. As we move through early 2026, gold continues holding near record highs. So what's driving this dramatic rise? ##3 key drivers. First, geopolitical tensions. Throughout 2025, escalating Middle East conflicts created what analysts call a fear premium. Airstrikes, regional unrest, and threats to critical energy corridors exposed just how fragile global supply chains really are. These tensions reminded investors and central banks alike that geopolitical stability can evaporate overnight. Second, U.S. economic uncertainty ***. Uncertainty in the United States has been mounting. Debt ceiling debates, unpredictable trade policies, economic policy reversals, and growing fiscal deficits have all eroded confidence in the dollar. U.S. Treasuries, once considered the bedrock of global financial safety, are starting to look less invincible. Just days ago, I covered how European pension funds have been actively selling U.S. Treasuries, citing Washington's political instability and fiscal irresponsibility. This wasn't speculation. It was explicitly stated in their press releases. Third, central bank action ***. In response to declining trust in the U.S. financial system, central banks acted decisively. Emerging market institutions, particularly in Asia and Eastern Europe, added more than 1,100 tons of gold to their reserves in 2025 alone. China, India, Turkey, and Qatar have been among the most active buyers, seeking protection against inflation, political risk, and currency volatility. Gold's share of global official reserves has now reached an all-time high of 25 to 26%, while Treasury holdings have declined. Why central banks prefer gold? The appeal is straightforward. With U.S. national debt exceeding $38 trillion, central banks are hedging their bets. Unlike bonds, gold cannot default. Unlike currency reserves, gold cannot be frozen by sanctions. Recent events have reinforced this logic. Renewed Israel-Iran tensions. U.S. military assets moving into the Persian Gulf. High-profile international incidents. These destabilizing events drive central banks toward assets with zero counterparty risk. Gold is universally recognized, physically ownable, and immune to default. What about the dollar? Despite gold's surge, the U.S. dollar remains the dominant reserve currency, accounting for roughly 45 to 58% of global foreign exchange reserves. Gold's rise doesn't immediately dethrone the dollar, but it does signal a structural shift. Central banks are clearly diversifying, reducing exposure to U.S. debt, balancing liquidity with safety, prioritizing assets that cannot be frozen or devalued. This trend accelerates as countries increasingly use local currencies for cross-border settlements, particularly in the global south. Broader consequences. This shift has 3 major implications. 1. Reduced demand for U.S. debt ***. Declining reliance on U.S. Treasuries will gradually dampen demand for dollar-denominated securities overall. 2. Shifting investor psychology ***. Confidence in traditional safe havens is being reinforced, changing how both institutions and individuals view portfolio risk. 3. New central bank priorities. Diversification and active risk management are no longer optional. They're essential for navigating today's financial environment. Looking ahead, as we move through 2026, the factors that drove gold's 2025 surge, geopolitical tensions, high global debt, and market volatility, remain unresolved. Gold's new status reflects broader structural changes in the global financial system. Reserve strategies, currency dynamics, and investor behavior are all evolving in real time. The critical question now: can gold sustain this newfound dominance? And if so, what does that mean for the US dollar, American debt markets, and the foundations of global finance? The answer remains to be seen, but one thing is certain: we're witnessing a historic realignment of the global financial order. Historical context: how we got here. To fully understand the magnitude of this shift, we need to examine how we arrived at this moment. The dominance of U.S. Treasuries as the world's primary reserve asset wasn't accidental. It was the result of decades of American economic and military power following World War II. The Bretton Woods Agreement of 1944 established the U.S. dollar as the world's reserve currency, initially backed by gold at $35 per ounce. When President Nixon ended dollar-gold convertibility in 1971, the system transitioned to a purely fiat-based model. The dollar maintained its dominance through the sheer size of the U.S. economy, the depth of American capital markets, and the geopolitical influence Washington wielded globally. For the next 5 decades, U.S. Treasuries were considered the safest investment on Earth. They were liquid, backed by the full faith and credit of the world's largest economy, and denominated in the global reserve currency. Central banks worldwide accumulated dollars and treasuries as their primary reserves, creating what many called an exorbitant privilege for the United States: the ability to borrow cheaply and run persistent deficits without immediate consequences. But cracks in this system have been appearing for years. The 2008 financial crisis raised questions about the stability of American financial institutions. The subsequent rounds of quantitative easing expanded the Federal Reserve's balance sheet to unprecedented levels, creating concerns about long-term dollar devaluation. Then came the pandemic-era fiscal stimulus, which added trillions more to the national debt in a remarkably short period. More recently, the weaponization of the dollar through sanctions, particularly following geopolitical conflicts, demonstrated that holding dollar-denominated assets carried political risk. When foreign reserves can be frozen or seized based on political decisions made in Washington, the concept of a safe haven becomes questionable for many nations. The gold standard revival debate. Gold's resurgence has reignited debates about whether the world should return to some form of gold standard. Proponents argue that gold-backed currencies would impose fiscal discipline on governments, preventing the kind of monetary expansion that has characterized recent decades. They point to gold's 5,000-year history as a store of value and its inability to be printed at will. However, most mainstream economists remain skeptical of a full return to the gold standard. The constraints it would impose on monetary policy could be severe, particularly during economic crises when central banks need flexibility to respond. The global gold supply grows at only about 1 to 2% annually through mining, far below the growth rate of the global economy. This mismatch could create deflationary pressures that stifle economic growth. What we're seeing instead is a hybrid approach: central banks maintaining fiat currency systems while substantially increasing their gold holdings as a hedge. This allows them to retain monetary policy flexibility while building a buffer against currency crises and geopolitical risks. Regional variations in the gold rush. The movement toward gold isn't uniform across all regions. Different countries have different motivations and strategies. Asia-Pacific nations, led by China and India, have been the most aggressive accumulators. China's official gold reserves have grown steadily, though many analysts believe the actual holdings exceed reported figures. The People's Bank of China views gold as strategic both economically and geopolitically, a way to reduce dependence on the dollar while supporting the internationalization of the yuan. India's central bank has also been a major buyer, adding to reserves that complement the country's cultural affinity for gold. Indian households have long been among the world's largest private gold holders, and the central bank's purchases align with this broader national preference. Eastern European countries, particularly Poland and Hungary, have dramatically increased gold reserves in recent years. These nations, positioned between Western Europe and Russia, view gold as insurance against regional instability and currency volatility. Poland nearly doubled its gold reserves in 2024 to 2025, explicitly citing the need for financial security in uncertain times. Middle Eastern nations, flush with oil revenues but concerned about long-term energy transition risks, have also turned to gold. Qatar, Saudi Arabia, and the UAE have all increased their gold holdings, diversifying away from petrodollar recycling into U.S. Treasuries. Latin American countries present a mixed picture. Some, like Venezuela, have tried to use gold reserves to circumvent sanctions, while others like Brazil have maintained more traditional reserve management approaches. However, even traditionally U.S.-aligned Latin American nations are quietly diversifying their reserve portfolios. Western central banks, by contrast, have been slower to increase gold holdings. The Federal Reserve, European Central Bank, and Bank of England maintain substantial gold reserves from previous eras, but haven't dramatically increased them. However, they also haven't been sellers, a notable change from the 1990s and early 2000s when several Western central banks actively reduced gold holdings. Market mechanics and price discovery. The mechanics of how gold reached $5,000 per ounce reveal important insights about modern financial markets. Unlike stocks or bonds, gold doesn't produce cash flows, making traditional valuation models inapplicable. Instead, gold prices reflect a complex interplay of supply, demand, and sentiment. On the supply side, global gold production has plateaued. Major mining companies report that easily accessible, high-grade deposits have largely been exhausted. New discoveries are increasingly in challenging locations, deep underground, in politically unstable regions, or in environmentally sensitive areas. The marginal cost of gold production has risen substantially, providing a floor under prices. Meanwhile, demand has surged from multiple sources simultaneously. Central bank buying, as we've discussed, has been substantial and sustained. But private investment demand has also accelerated. Exchange-traded funds backed by physical gold have seen massive inflows as investors seek inflation hedges and portfolio diversification. In countries experiencing currency crises or high inflation, retail demand for gold coins and bars has spiked. The futures and derivatives markets for gold have also played a role in price dynamics. As spot prices rose, speculative positioning increased, potentially amplifying the move higher. However, the gold market remains far less leveraged than many other commodities, and the existence of large physical stockpiles provides a stabilizing influence. Implications for the dollar's future. While gold's rise doesn't immediately dethrone the dollar, it does accelerate trends that could eventually reshape the global monetary system. The dollar's share of global reserves has been gradually declining for 2 decades, from over 70% in the early 2000s to roughly 58% today. Gold's ascent contributes to this trend. Several factors could determine whether this decline continues or stabilizes. U.S. fiscal policy will be crucial. If deficits continue growing without a credible long-term plan, reserve managers will have additional incentive to diversify. The Federal Reserve's monetary policy also matters. Sustained low real interest rates make dollar-denominated assets less attractive. Geopolitical factors loom large as well. The more the dollar is used as a tool of foreign policy through sanctions and asset freezes, the more other nations will seek alternatives. We're already seeing this with the growth of bilateral trade agreements that bypass the dollar, the development of alternative payment systems, and increased use of local currency swaps. However, the dollar still has significant structural advantages. The depth and liquidity of U.S. financial markets remain unmatched. No other currency area comes close to offering the combination of size, openness, and legal protections that make the dollar attractive for international transactions. The euro has structural challenges due to the eurozone's fragmented fiscal system, while the yuan faces limitations from capital controls and questions about legal and political institutions. Gold, for its part, cannot fully replace the dollar's role because it lacks the scalability needed for the trillions of dollars in daily international transactions. You can't easily pay for container ships of goods with gold bars. What gold can do, and is doing, is serve as an increasingly important store of value that operates outside any single nation's control. What investors should consider. For individual investors watching these developments, several considerations emerge. First, the fact that central banks are buying gold doesn't automatically mean individuals should. Central banks have different objectives, time horizons, and constraints than private investors. They're managing national reserves with intergenerational time frames and geopolitical considerations that don't apply to personal portfolios. That said, gold can play a role in diversified portfolios. Its low or negative correlation with stocks and bonds can provide valuable diversification benefits. During periods of financial stress, gold has historically performed well, offering a hedge against extreme scenarios. Most financial advisors suggest that if gold belongs in a portfolio at all, it should represent a modest allocation, typically 5–10%, rather than a concentrated bet. The choice between physical gold, ETFs, mining stocks, or gold futures depends on individual circumstances, risk tolerance, and investment objectives. Physical gold offers the ultimate security, but comes with storage and insurance costs. ETFs provide liquidity and convenience, but carry counterparty risk. Mining stocks offer leverage to gold prices, but also exposure to company-specific and operational risks. What we're witnessing isn't simply a bull market in gold. It's a fundamental reordering of how sovereign wealth is stored and protected. The shift from U.S. Treasuries to gold as the dominant reserve asset represents a loss of faith in the post-World War II financial architecture and a return to more tangible, politically neutral stores of value. This transformation raises profound questions about the future of international finance, the role of the dollar, and the balance of global economic power. As we progress through 2026 and beyond, these questions will only become more pressing. The world is moving toward a more multipolar financial system, one where no single currency or nation dominates as completely as the US did in the late 20th century. Understanding these shifts isn't just academic. It affects everything from inflation rates to interest rates, from trade patterns to geopolitical alignments. The rise of gold to supremacy among reserve assets is a symptom of broader changes that will reshape the global economy for decades to come. I hope you found this analysis valuable and learned something new. If you did, please like, subscribe, and share this video with your network. Stay informed, stay critical, and I'll see you in the next Newsix Brief.